Hello and welcome to 15 for 15. I am your host, John Zalkin from RKW Residential. 15 for 15 is a new and exciting video series where we interview 15 influential real estate people for 15 minutes each, where we get their perspective on what is happening in real estate during COVID-19. A little bit about RKW. RKW Residential is an award-winning third-party multifamily property management firm with over 20,000 multifamily units under management and a growing footprint spanning 6 states. RKW delivers expertise in multifamily management through its technology, marketing, and customer experience platforms. My guest today is Brian Gaswirth from JLL. Brian is a director in the Miami office of JLL. He is primarily responsible for originating and executing joint venture equity, preferred equity, mezzanine financing, and senior level financing for real estate assets located throughout the United States. Brian, it is great to see you, and thank you for taking the time to join me on this episode of 15 for 15. I'm really looking forward to hearing about what you're seeing in the capital markets today. Can you briefly just expand on your bio a little bit and then dig and start going into what you are seeing in the capital markets and debt markets today?
Sure. Well, first of all, thank you for having me. It's great seeing a face that's not my wife's for the first time in a while. So it's a nice relief.
I got all dressed up for you today
too. So thank you again, and appreciate you allowing me to be on here. So listen, so by way of background again, I work for JLL in the capital markets. I come by way of the HFF merger. And so as John mentioned, most of what we're working on are equity and debt placement throughout the country with a specific focus on multifamily, retail, and office. So I have a good, array of information that I could give and how different groups are looking at different properties and how the lenders are looking at that as well. And then, a lot of what I do as well is structured type equity and debt. So a lot of construction work. So listen, your first question is a fairly loaded one. What are we seeing in the debt markets today? So listen, as everybody has seen, there's a tremendous amount of volatility. There's a lot of uncertainty right now as to sort of what does COVID-19 look like and how does it impact us and what is the term in which, we're sort of all, sitting here doing virtual conversations rather than being in front of people. So I think the first and foremost, the one thing that has obviously hit everybody's radar, the most recent, right, is the CARES Act. Right, the CARES Act is, in my personal opinion, something that the government absolutely needed to do. It was a very proactive approach. I think last time around during the global financial crisis, they waited a little bit too long, and it was more of a reactive rather than a proactive situation. So I think what we're seeing today is we are starting to see some sort of normalization in the capital markets from a debt and an equity perspective. Just to put it into perspective right now, if you look at the investment grade corporate bonds back in the beginning of March, right, you were seeing yields anywhere from 2.25 to 2.7%. And today you're seeing those yields around 2.8 to 3.5%. So we're still, call it 50 to 100 basis points wide of where we were. But a week and a half ago, we were 150 to 200 basis points wide of where we were, right? And why that's important is lenders use corporate debt as a benchmark for how they're pricing their mortgages, right? So in all else remaining equal, right, a lender, they have a certain basket of goods that they could invest in. They could buy corporate debt or they could invest in mortgages. And for the most part, they prefer corporate mortgages, one, because it's backed by the good faith of a company, right? It is a very liquid investment, so it's mark to market on a daily basis. And so that clarity alone gives them, much more confidence, right? So when they're investing in mortgages, they use that as a benchmark and typically have an illiquidity premium that they add on top of those yields to get to where they're sort of pricing mortgages. So in the beginning of March, best of the best type debt, right? Call it 50% leverage, multifamily or industrial from the insurance companies was pricing in the 2.75 to 3% range. Today, we're closer to 3.75 to 4%. when last week we were in like the 4.5% range. So all of that volatility in the marketplace, right, has just caused, obviously confusion in terms of what is pricing. And that's just from the insurance company perspective, right? If you look at the bond markets from a CMBS standpoint, right, obviously the amount of volatility there has essentially taken CMBS lenders out of the market, for lack of a better term, because the liquidity on the back end to acquire those bonds is just not there right now. Essentially what you've seen is, because of all the volatility in the marketplace, there's been significant fluctuations in the value of CMBS paper that a lot of the investors currently own, which has created margin calls, right? So I'm not sure if you've seen, but there's been some of the largest institutions in the country have had liquidity issues because they've had margin calls on their current portfolio that they haven't been able to meet, right? And essentially what that's saying is, the value of their investments have decreased to such a point where their brokers are, asking them to, put up additional collateral or put up additional liquidity to sort of satisfy their margins. And so, again, all of this has to do with just the relative uncertainty in the marketplace. What is value today, right? How are investors looking at new deals, et cetera? So, from that perspective, I say that, I think that the CARES Act is bringing us into a much better position, right? It's starting to normalize. Spreads are coming in, but I still think that there's, some water to be swam through in order to get to the end of where we need to go.
I think this is, as they say, dead cat bounce in the stock market, where this act came out and money came in, but if you own a retail center, a shopping center, you own an office building, or even multifamily, does anybody really know what that property and the value is at? Do you have any examples of deals that were under contract, or things being retraded by your clients, by the purchasers, or anything like that, or is it still too early on your side?
No, I mean, listen, there have definitely been deals that have been dropped for one reason or another, right? It's the repricing of risk again, right? What you knew 3 weeks ago going into a transaction completely was turned upside down today, right? So, deals in Orlando, for example, right? Obviously, it's a very big tourism-based community. They have a lot of other great jobs, from the STEM, et cetera. But, if there were deals that were under contract from a multi perspective or an office perspective that were very tourism centric, right, that, may have been dropped, right? Because, again, you just don't know what the viability of the tenants in those properties are on a go-forward basis.
Are you seeing that on the multifamily? Because Orlando was the hottest market probably in Florida. Going into.
Oh, absolutely. I mean, in the country, I mean, Orlando was the belle of the ball, right? I mean, if you look at Orlando from a population and a job growth perspective, it is, in the top 10 across the country, right? With all that being said, right, it's either Fannie or Freddie, I don't remember exactly which one, recently downgraded them to a lower tier market because of the potential impact that we're seeing with the tourism and all the layoffs or furloughs that have occurred in the market. So Orlando is a potentially scary market. I mean, look at Miami too. I mean, Miami has 3 large cruise companies, a few large airline companies that are domiciled here. So I think it's going to be a market by market basis. But to the other side, right, we have seen numerous deals close that were already under contract. A lot of those, either didn't have financing contingencies or they were able to be financed through one of the balance sheet lenders. Listen, at the end of the day, insurance companies are the lifeline of mortgages, in my opinion, in addition to the agencies, because insurance companies are always there through thick or thin because they're lending on their balance sheet, right? Really where we've seen the biggest issues thus far are from groups that need to rely on some sort of capital markets execution on the back end in order to satisfy their yield requirements. So CMBS lenders, right? They need to turn around and sell their bonds to investors in the market, right? There is just no liquidity there today for that. Debt funds.
Do you think the Fed steps in and starts buying the CMBS loans?
So there's been talk. As of right now, the CARES Act does not talk about them buying commercial mortgage-backed securities, I believe. So I think there will be some sort of relief there, but it hasn't been fully announced yet.
And what are you seeing in terms of workouts right now with some of your clients? We've had some people on who've spoken about how their retail clients are saying we're not paying in the multifamily side. Like Fannie and Freddie. I'd like you to touch on two things. One is the Fannie and Freddie, where they're coming in on the multifamily side, but also across the board, what's happening with workouts and what are you advising clients on today who, aren't going to be collecting as much rent as they thought they were last month?
So, the honest answer is, and it makes me feel good about where we are as a world, right? I think everybody, sort of downplays this, but, I think everybody's actually working together in this regards. Nobody's really pointing fingers because at the end of the day, it's nobody's fault, right? As to what's going on here. So from a Freddie and Fannie perspective, they've already released guidelines that will allow their borrowers to forego debt service payments for a period of 90 days, so long as they can prove that there are collections issues at the property stemming from this virus itself, right? So essentially what they're requiring is that, their borrowers, submit certain files and paperwork that just show, what their collections were, what they're today, sort of what they're doing to help with, getting those collections back into a normal position. But they are foregoing 90 days worth of debt service and escrows in order to help borrowers out during a period of potential collection loss. The FDIC has sent a informal letter to banks to have them work with their borrowers as well, both from a mortgage perspective and from a personal loan perspective. So you are seeing a lot of the banks following suit with the agencies and allowing them to forego any debt service for a period of time. And then also, again, with balance sheet lenders like insurance companies, they are also working with their borrowers, right? I think everybody right now has been super focused on asset management, especially for hospitality deals, because those have been hit the hardest, the soonest. And then they're shifting their focus to retail, multifamily, et cetera, in order to work with those properties.
It's amazing. Times certainly changed for the last 30 days till today. But with that, and 15 minutes goes by fast when you're having fun and you're having interactions with other people besides your wife. So we're reaching the end where I do a little segment I like to call the lightning round. I'm going to ask you a few quick questions, answer yes or no, over unders, and it gives a little change of how things go. So are you ready for your lightning round?
I'll try.
Let's do it. Okay, first question. Does the 10-year close under or over 1% in 2020?
Under. And I think it closes under in 2021.
Next time, a little bonus. Next time you're on an airplane, over under 90 days?
Under. If it's over, I'm going to jump out my 2-story balcony.
Next time you attend a networking event, over under 90 days?
Over 90 days.
Next lunch or dinner at a restaurant with a client, over under 90 days?
Under 90 days, but it'll be a larger table than normal.
Is the election suspended, yes or no?
Wow. No.
Will Trump win or lose?
Fortunately or unfortunately, depending how you're looking at it, I think Trump wins, but that's just because of the competition on the other side.
Does the stock market end over under 20,000 at the end of the year?
I'm praying for over.
Does the U.S. COVID-19 infection rate go over under 500,000 people in the U.S.?
Wow. Considering they're now saying that you could get close to 100,000 deaths, I'll say over.
Okay. And last but not least, do you think you will be on a vacation in the next 6 months?
If I'm not on a vacation in the next 6 months, my wife will kill me.
Okay, there you go. Brian, I really want to thank you for joining me today on this episode of 15 for 15. Everyone, we hope you all stay safe and practice social distancing and make sure to wash your hands. Brian, really, thank you so much again.
Thank you, John. I really appreciate it. It's good seeing you and can't wait to get together in person sooner than later.
Absolutely. If you have any questions or would like to find this video, please visit rkwresidential.com.